Welcome to Tell Me More, a hospitality data podcast. I'm Stephanie Ricca, as always, here with STR's Isaac Collazo and CoStar's Jan Freitag. Hi, guys.
Hey, Stephanie from a cold, wintry Nashville.
Hi, Steph. The office closed today. We're all at home.
And where are you, Steph?
Well, dear listeners, all three of us are in Nashville as we record this episode in February. But it actually snowed here. So I have to say that I, as the Clevelander, probably brought the snow with me. I'm sorry. And I hope that this does not mean that we're going to talk about chilliness or freezing over or any sort of like cold, awful, apocalyptic slant to the hotel data. Let's just pretend that it is sunny and warm outside, right? Optimism.
Optimism.
Also be clear that what you in Cleveland call snow and what we in Nashville call snow that shuts down everything are two very different things. I think we got like an inch and a half or something. So
see, it goes to show this is all a street corner business, whether it's weather or the hotel industry. And, I will say so far this year, there's been a lot of snow, and in general, 2025 has roared in like a lion. Since last we spoke, the three of us, I want to share a few key hotel industry headlines that have happened. Of course, we saw more storms, more fires, more, weather issues and challenges. We all, of course, then went to the Alice conference in Los Angeles in late January, where sentiment was overall a little of what I would say is underwhelmingly sort of optimistic. That's kind of my
Didn't you say uninspiring, Jan? Uninspiring? Is that
Jan
what you
said
used?
Uninspiring, precedented. So I riffed off that for underwhelmingly sort of optimistic. So there was that. We saw CoStar and Tourism Economics revised forecast showing pretty flat growth this year in the key performance indicators. And, we're about midway through the Q4 and full year public hotel company earnings reports, which have been honestly pretty good, especially on unit growth and revenue per available room expectations. So that's been a highlight. Did I forget any major headlines, guys? Anything you want to add?
No, the only thing I heard. Oh, sorry. Go ahead.
No, the Playa deal went through, right?
That did,
and then
yes.
IHG yesterday announced they bought Rosie. No, what am I saying?
Ruby.
Ruby. Sorry, Ruby. They bought Ruby. So yeah, everybody at Alice said, "Oh, we just need a catalyst. We just need somebody to step forward." And now we got two companies making brand deals. So that was interesting.
And the thing I heard yesterday, because I hadn't heard of that, it wasn't yesterday, but my team was telling me FeePAR. Have you heard of FeePAR?
What's that?
Like
per
fees
available?
Yeah, I had never heard that term.
Oh,
and so one of the large companies was talking about their FeePAR, and I thought, wow, I've never heard of that. That's an interesting new concept.
I have never heard that either. And, the bigs so far have spent a fair amount of time on those Q4 calls talking about fees, revenue, and, by and large going up. So FeePAR. All right. Well, listeners, you heard it here first. There's our first buzzword of the year. So I want to start now, listeners. We are, after a couple months of end of year highlights and beginning of year predictions, we're kind of falling into a more regular pattern, a normalized version of the Tell Me More podcast. So as usual, we are going to start with a quick cruise through the data. Isaac, why don't you gallop us through January hotel performance highlights?
Well, there's nothing normal about our industry at this point. Let me tell you that. And it just keeps getting weirder and weirder, but to the betterment of the industry. So RevPAR was up in January 4.5%.
What? Wait, one more time?
4.5%.
I don't want to question the data, but are you sure? That seems like an amazing.
Jan, yes, it is amazingly high. It's exactly the same as it was in December. That's the first thing that's very interesting to me, that December was 4.5 and January is 4.5. But there's a lot to unpack here. First of all, there are a lot of things, and you mentioned it, Steph, about weather. So there's weather impacted events, there's special events. So let's go through it. Let's go with the special events. I picked two. the inauguration in DC that happened in January, and the NCAA championship game in Atlanta. We know that happens all the time, but I still put it in there as a special event. Those two markets, RevPAR was up 28.7%. Okay, that's one set. That's only two markets.
Okay, wow.
Then you get to the hurricane markets from last year. Hurricane Helene and Hurricane Milton impacted 13 markets. Those 13 markets in January were up 23.8%.
Okay.
Then you add the greater Los Angeles markets that were impacted by the fire. We have four markets there. Those markets were up 8.8%. So then that leaves the top 25 remaining, or 20 markets of the top 25 that remain. They were up 2.6% in January, and then everything else, 133 markets, up 1.3.
Okay. Now that number sounds a little bit more normal.
So therefore, if you take out those weather special impacted markets, you're really looking at a RevPAR of 1.8%. And that is down from December. So what I did is I ran a trend with all just the 20 markets that were left in the top 25 and the 133. So basically markets that shouldn't have had any impacts, even though they probably did. We just don't remember what they were. And so that's a 1.83% increase. Again, in December of last year, they were up 3.6. So, they did come down as we'd expect, and it's more like November kind of growth. I thought the other thing was very interesting is to look at it by class. So if you look at the classes, economy hotels were up 5.7%. But again, that's because of those weather impacted and those special event markets. If you take them out, they come down to more reasonable numbers. They're still slightly positive, but not 5.7% in terms of RevPAR growth. Big winner continue to be still bifurcation. Luxury hotels overall were up 10.5%. So again, big growth winners there. Other thing I noticed was ADR was at 3.4% for the U.S. overall. And again, that was the highest, not the highest since November 2023. This month also saw the first time that we surpassed 2019 for January since 2022. So we sold more rooms this January than we had in the last 2 years. But even with that, and even with the higher RevPAR and ADR, real ADR was down 4.2% versus 2019, and real RevPAR is down 7.6% versus 2019. All to say is the recovery has not been completed yet. So again, we still have a long way to go to get there.
A little chilly, Jan. Do you think we can bring back our weather metaphor?
So we are in this very interesting position now with the data, the way Isaac parsed it out, right? You have the top line, and I'm like, wow, that's really high. Are you sure that's right? And the answer, of course, is yes, that is a true number. But then you unlayer it and you take out and you say, well, what about this? And what about this? And what about this? And so this is sort of a little bit like looking at real versus nominal RevPAR growth, right? We're all taking nominal RevPAR growth to the bank, but we also care about the inflation adjusted number. So yes, the RevPAR was really, really strong, but we will put asterisks on this data set. And that's what we do as data people. But I think operators are like, no, who cares? I'm in Atlanta. I had a great month.
Right.
You guys, can go away.
But that's why I thought we needed to unpack it, because not everyone had a great month. That's the key, right? Because if you look at 4.5%, you go, oh my God, well, I didn't get that. What's wrong with me, right? And so here it's going, wait a minute, it's certain markets, certain areas that are really benefiting from special events and weather-related events.
In my business, we call that you got to explain the headline.
Yep, exactly.
Sometimes it is not what it seems.
And just to finish this off, just to talk about the rest of the world really quick, it was a really good month for the rest of the world. With the U.S., January RevPAR globally was up 8.8%. If you take out the U.S., it was up 10.6%. And I looked at it, the top 10 countries, we look at it by supply versus all other countries. They were, top 10 were up 8.9%, while all other countries were up 13.4%. And some of the highlights, I just looked at the top 10. Japan was seeing a 30% increase in RevPAR. And some of that is, it's on the ADR side,
Wait,
21%.
30%? This is
30%.
my turn to interrupt and say, really? Wow. Okay.
And
I
some of
believe it,
that,
Japan.
yeah, and some of that is related to the yen itself. So there is some currency issues there. But when you look at the demand side, because you can always say, okay, that's not real, but demand in Japan was up 8.4%. So, I mean, very strong demand. Thailand saw an 8.10% increase in demand and a 22% increase in RevPAR. So it was really, I mean, there were some strong numbers around the world. So people are traveling, as we said they would after the pandemic. They continue to travel, and you definitely see it in those demand numbers. And just remember, demand globally is above 2019 and has been above 2019. So this is growth upon growth.
Growth upon growth. That's a good sort of controlling theme. I mean, I know it's only February, but let's see if that sustains. Okay, so now it's time for our first topic of the month this episode. And Jan, let's talk about pipeline a little bit. You know, I was in a conversation with somebody this morning who was asking me about the huge boom in ultra luxury travel demand. You know, all these people, of course, White Lotus season starts and everyone wants to talk about luxury hotels. And they asked me, this person said, Steph, so all these people want to stay and pay these high rates for these luxury resorts. How long does it take for a hotel investor today to say, hey, we want to build a resort in Thailand? You know, is that demand going to still be there when the resort opens X number of years down the road? And I said, let's talk a little bit about hotel pipeline. So Jan, give us the highlights. I don't think we've talked about this in a while on the pod.
Yeah, we may have not talked about it for a while because the data hasn't changed
There
very
hasn't
much.
been much of a pipeline.
There is some, but it's just the change has just been de minimis. We are, Isaac and I and yourself, Steph, we're on stages all across the country all the time. And I show the same chart every month and say, hey, if you've listened to us, you know, in the last 6 months, this is the same data set. So basically the highlights are in the United States, we have had between 150 and 160,000 rooms in construction for 38 months. For over 3 years, it's been the same number. In December, 154,000, that is up 1%. Call that flat for all intents and purposes. What does that mean? That means that some projects open, and those are backfilled by some projects that are breaking ground. So not everything is coming to a standstill, but it's just basically the same number. You've maybe seen there are a couple of press releases out there from other entities that talked about the number of projects is the highest it has ever been. And that's true. We count, 770,000 rooms in the total active pipeline. But to me, that number is a little bit, I don't want to say misleading, but I'm sure it matters very much because I have a dream and I have a piece of land and I talk to a brand and then I talk to a bank and I'm like, oh, this is really expensive. Let me just wait.
Funny how that works.
So we have a lot of stuff that's in planning and in final planning, but we haven't broken ground yet. Like the in construction is still ways off. So the planning phase, 350,000 rooms, is up 10% year over year. Yeah, will those happen? Maybe. Some of them, sure. I mean, we have an attrition rate, but a lot of those will happen, but not today, not tomorrow. So new supply is continue not to be a headwind. It's really in some markets, arguably it's a tailwind if you are an existing operator. What are we building? Not a big surprise. Upscale, upper mid-scale really is where the action is. 40,000 rooms in upper mid-scale. That's where the publicly traded companies are putting all their attention, and that's where investors and lenders are saying, yes, we understand the model. Let's build more here. If you take the number of rooms in construction and divide it by the existing supply for luxury, you get a 5% growth rate. Now, that's a lot, but that's just if you take the snapshot of rooms in construction today and divide it by existing. So you have to think about, those are not going to happen over the next 2 or 3 years, maybe. So if you divide the 5% by 2 or by 3, you get, 1 point something percent growth, much more manageable. Back to your very early opener, how long does it take? for somebody to from thinking about it to actually opening. We did this study. This is pre-pandemic data, but I think it probably still holds. We did it by chain scale, and for luxury properties, we found it took 5 years from somebody saying, "Hey, I have a dream," to opening the doors, to getting the land, to getting it entitled, to then getting it planned, to getting it designed, getting it financed, and then getting it built. 5 years. So, yeah, you hope that the customers by then are still around. Some tented camps, obviously, some properties with only 20 rooms or so. There's a lot. Those can be done a lot faster. But in general, 5-star resorts just take that long. And then the markets that are very active, not a big surprise. We are here in Nashville, Tennessee. You take the number of rooms in construction divided by the existing supply, 6.6% expected growth. Again, think about that over the next 3 years or so. That's still a 2% handle. That's rare. New York, Phoenix, Dallas, Miami, those are the top 5 markets. Clearly investor darlings, clearly in the sort of the smile states. New York, always an outlier because everybody wants to be there. It's very, very hard to get anything done with the new legislation. But then you have the short-term rental ban, and you have 16,000 rooms, or now I guess it's still 13,000 rooms taken out of supply to house the unhoused and refugees. So New York is always interesting. But Nashville, New York, Phoenix, Dallas, Miami, those are the investor darlings. That's where the action is. But in general, the number of rooms in construction is really not that big of a deal. So that's why we don't talk about pipeline very much, because not a whole lot to report. So ask me after NYU and see if anything changed.
Nothing's going to change.
I've got a thought. You know how we always start the pipeline with planning phase, right? Maybe we extend that out and we put some numbers behind the hoping and dreaming phase, the wishing and hoping and phase. We all know that guy who will talk to you at a party about the luxury boutique hotel he wants to build. That's the part of the pipeline that, oh my gosh, I don't even think that STR and CoStar could quantify data around that.
Well, we used to call that pre-planning.
That's right.
I used to call that, I read it on the internet.
Oh, God. Jan.
Because we literally had a research team that would say, oh, here's an owner who says, I have a piece of land. I'm thinking maybe multifamily, maybe an office, maybe a hotel with condos. And we would put that in the pre-planning phase, and I'm like,
I read it on the internet.
Who knows? So that's the rumor vaporware stage for sure.
But just to give you an idea, I did a presentation for a group outside the US, and we're looking at just luxury, upper upscale, and lifestyle brands. And to give you an idea, when we did this presentation, which was just about 3 weeks ago, we identified over 265,000 of those rooms were under construction worldwide. And 35% of those were in China. So just give you where that construction, especially on that higher end luxury, upper upscale and lifestyle. And then you wouldn't be surprised. The list includes Middle East, Africa, then the rest of Asia, then finally the US. And the US accounts for only 9% of those room types.
And Middle East, Africa is Saudi,
right?
Those
exactly.
those giga projects,
right.
That where they're sort of terraforming the desert and making it livable, incredible feat of engineering and lots of luxury rooms.
Correct. I agree.
Now it is time for Isaac's topic of the month. And Isaac, you shared an interesting data point with me this morning, and we're going to unpack it right now. I won't say it yet. I'm going to let you say it, but it's the percentage of hotels that have fully recovered occupancy to 2019 levels. But before you share it, should we have Jan try and guess the number?
Yes, Jan.
Okay, so the question is the number.
Were you not paying attention?
The percentage of hotels.
I just want to make sure I get this right.
Is this U.S. or global, Isaac?
Global.
Okay, so percent of hotel rooms or hotels?
Hotels. I did on a hotel basis.
Hotels
with an occupancy that above 2019, full year 2024.
Well, if you asked me room rate, I would say likely 100, like 98%. So
we're not talking room rate.
We're not talking room rate. Okay, so occupancy. We haven't. I don't know. I don't think we're quite there yet. Like, call it like a third, maybe.
Okay, that's pretty close. Yeah, the number is 40.2%. So
okay,
40
okay, so 4 and 10.
Yeah.
Okay, wow.
Yeah,
Okay.
40.2% of all hotels globally that report data, and they were comparable. They had to been open in 2019, 23, and 24, so I could do the data right. And 40% of them have an occupancy above where they were in 2019. But it really varies across the world. So the lowest recovery rate we just talked about a few minutes ago was Japan, where only 27.6% of hotels are above their 2019 level. It's a smaller sample size, just FYI. There's only 840 hotels in that market. We have the comparable data. So that's the key, right? We know there's more hotels, but I have to make sure that everything's apples to apples. And then on the high end, it's also a low sample, but it's India, where 61.5% of the comparable hotels are above 2019. And we're talking 912 hotels that are considered comparable in that market.
Wow.
And then for the US, a little bit lower at 37.3. And I think what's interesting about the US and also Canada and a few other countries is that we went backwards, that we actually had a higher percentage of hotels with an occupancy above 2019 a year ago, full year 23, than we do today. And so globally, the number actually fell slightly, 0.3% lower this year than it was last year. So yeah, I mean, it's really interesting to watch this. I'm fascinated by this because again, I still remember my early days in the hotel business, and it's heads and beds, right? So it's occupancies, demand. That's how you know if
Right.
you're back.
I was
And
just going to ask, is this your number for true demand then?
yeah, yeah, basically, yeah, because then this is where a hotel truly has come back. Everything's working back for them. They should be feeling good because we know ADRs are up, while they may not be at the rate of inflation adjusted above 2019. And that's the next piece. I actually have that connected to all this, but I didn't bring that data with me today, but we can actually look at that for the next time to think about that. But it's really, to me, that's it all begins with demand. You've got to look at demand. And then just look in the US before we go just a little further. I just want to give you what other number. So we know it's 37.3% in the US total, but there are regions of the country where it's higher. So if you look at the Northeast non-top 25 markets, that's up 42.8%, or not up, but 42.8% of those hotels are back to where they were in 2019. On the flip side, and you should be able to guess this one, Jan, where would you think region and type of market, which would be much lower than the national average? Just take a guess.
I mean, further up north, right? The outside of the smiles. Like I would go up Chicago, Minneapolis.
Go west, young man. Go west, young man. So in the western region of the U.S., and within the top 25, only 26.5% of hotels are at their 2019 levels in terms of occupancy. That's really low.
Wow.
And then same thing, Midwest, you were close as well. Jan, Midwest, top 25 markets is 27.4. So that's where the lot of the recovery still needs to really get ignited, because that's where the hotels are still suffering the most.
And remind us, do you know off the top of your head what, and I know it's not market by market, but what total US occupancy, like the total number was at end of 2019 for full year 2019?
Give me a few seconds. I actually have that. I don't remember top of my head, but I can tell you.
63.
Okay, somewhere in the 60s,
63.
early
No,
63
60s.
was 2024.
65.8% was
Okay.
2019, and we finished 2024 at 63.
And those were US?
That is US,
Okay.
correct.
All right, that gives it a little context. Wow.
And
So,
But so you're looking here at same store. These are the same hotels. This is not
Right.
taking into consideration any new supply, right? And
correct.
you're saying, oh, the occupancy hasn't fully recovered. But of course, new hotels opened in all those markets, right? So demand,
No,
would
demand's
have,
not fully recovered yet either. So in the US, so
right?
it's down at 0.4%. So yeah,
So there's a demand story, but there's also a new supply story, right?
Right,
Like
right.
these hotels have more new competition.
Yeah, they do, of course. Yeah, and I was going to do some more deeper look because I really want to look at what hotels have won. My
mhm.
gut feel, it's going to be a smaller hotel, right? So a 150 room hotel, it's not going to be, but I also want to see what percentage of large hotels above 300 rooms are back and really understand that as well. So I did that before, but I haven't done it for 2024. So
because group demand has not fully recovered yet, but transient demand has.
Correct.
And so that makes sense. That intuitively makes sense to me, that if you don't have ballroom space, you were just a beneficiary of pure transient demand. But if you're trying to get groups, yes, groups are out there and they've grown year over year, 24 over 23, just not compared to 19.
That's correct.
Then it'll be interesting to see when that, just the overall rise of those percentages, once you can maybe look at the hotels by class or by size like that, to see the impact of group and
another thing we can do, and I did this for an HDC a few years ago, we can look at it by what percent of U.S. hotels were in what category of occupancy, between under 50, 50 to 55, 55 to 60 that way, and then see what the categories are today, which then accounts for every hotel. We could bucket every hotel that way and really get a sense of where are we on that bell curve. Is the bell curve still shifted to the left, where occupancy, we know overall U.S. occupancy is down, and how's it moving to the right? So that'd be cool, and that might be a great idea, Steph.
Let's plot it on an interactive map where you can look year by year, state by state, and then we'll publish it on Hotel News Now. I love it. Should we do it? Let's do it.
I was thinking HTC, but this is even better. This is real time. I like that. That'd be great.
So here again, we are at the conclusion of our episode. And before we go into the favorite part that everybody loves so much, their metaphors, I want to give a little commercial for the Hotel Data Conference. So Isaac mentioned that, some of this research we've seen in different iterations over the years. For those of you who are not familiar with the Hotel Data Conference, this year's event registration opens on March 1st. So by the time you listen to this episode, it'll be just a few days away. So mark your calendars, hoteldataconference.com, and get in before we sell out. So guys, before I ask you your metaphor for the month, I want to circle back because I kind of see this little segment of our podcast as sort of the entertainment corner, sometimes the true confessions and therapy corner. And I've got to say, for the very first time, watched an episode of White Lotus. We talked about it earlier in the episode.
Did you watch season 3?
I watched season 3, episode 1 last night here in my hotel. I've never seen it before because, it's like the shoemaker's son always goes barefoot. It was beautiful. It was very cool. But I've got to tell you, I had a little bit of like, oh my gosh, all day long we're writing about and dealing with the trends of ultra luxury and the difficult guests and the crazy demands and the wellness trends and authenticity. So I felt a little bit like, whoa, I talk about this all day at work. I don't know if I want to watch it on TV. Am I the only one who feels this way?
I didn't even think that way. I just thought it was a very dark beginning to season 1 or season 3. It's dark. There's a dark undertone there. Something's up, and I couldn't figure it out. Well, we know
the storyline I think will be fun. I'm going to enjoy watching this. I love to be a late adopter of a show because then I get more episodes to watch. But did any of you feel that kind of like, oh my God, here's the crazy wellness trends at an ultra luxury hotel? Tell me more.
I just thought it was crazy people. I don't think it has wellness is good, but there's some really interesting characters in this one.
Which I guess look is at the true authenticity.
I look at this and look at the GM and the senior staff of the hotel, and I'm just like, oh man, in a different life that would be me. Like that was, I wanted to be that, like
I'd be calling you Jan. My water is
GM of the White Lotus.
My water's not chilled to 50 degrees like I wanted it.
Exactly. That's what you deal with. I'm like, wow, how do people do this? I mean, I still get the appeal of being a GM in a Hyatt, or really in any hotel. Like I got a tour of the new Hyatt caption here. Brian was nice enough to show me around, and it's just fascinating, to see the new brands and see the new brand stands and see new properties, and just the service delivery is just so fun. And to see it on TV, sort of dialed up to a 12, in the Wild Lotus session is also super interesting. But man, the guests, wow.
Yeah, they're crazy. But talk about, you got a tour of the caption, and I want to see that. I've walked by it, but I haven't seen it yet. But Steph, you got a tour of Six Sense, that's the Regent. The Regent at Santa Monica. Yeah.
So you know what? I thought it was gorgeous, and I had not been in that hotel when it was a Lowe's in its previous life. But what I thought was really cool about the design is that it's something new. We kind of see sort of the same old when it comes to minimalist luxury or, depending on what these major design trends are. But this one leans in to, dare I say, a little bit of 80s chic. It's got this like mirrored arcade, not mirrored, windowed arcade domed ceiling, which looks like a mall in the 80s. And so, of course, gorgeous light, gorgeous views. It's right on the pier. But the soft seating, the lobby furniture, the lobby bar area, it's very curved and, giving that 80s glam. So I don't know, maybe it's back, but it was gorgeous. Great to see that brand.
And you saw the room, right? I heard the rooms are ginormous.
The rooms are huge, absolutely huge. The fitness center is 2 stories. Like there's just a lot of space there. And they were busy. This was a Monday afternoon. They had been taking in quite a few evacuees from wildfires. And so it was really interesting space to see. So that's always fun when we get a little glimpse of, the White Lotuses of the world.
We are not as demanding. We are reporting. We are reporters. We are for the industry. We are not crazy guests.
Right.
Yeah, my rider for staying at hotels is very limited.
We'll see. Give him the chance, he could go wild. All right, let's talk about our metaphors. Jan, have you thought of one? I've been trying to buy you time. Have you thought of one? What does the hotel industry feel like to you right now?
So the office is closed because the snowmageddon hit with 1.5 inches of snow. And so I took the morning off, took some PTO, and my boys and I went sledding. And so that is my metaphor, is that the year starts out really fast, and then it slows down. And I hope you don't fall off the sled, dear listener.
Well, tomorrow your back might hurt. What does that say?
Yeah, exactly.
The industry? Have fun today because your back might hurt tomorrow.
Exactly.
And mine's very similar. It's really similar, actually.
Oh.
It's a roller coaster. So if you're following our weekly data, you know that we started the year, very high RevPAR. Next week fell. The following week was real high. The following week fell. And it's been like that continuously since the start of the year. So to me, it's a roller coaster. And since we always do music, the song to go with it. So if your listening pleasure would be Bleachers Roller Coaster. Jack Antonoff's band. So
ding,
Bleachers.
ding, ding. Isaac, I think you've used this one before.
We did?
I think
in this
maybe
industry, I would not be surprised.
But it's a roller coaster of a ride.
Oh, I didn't even look at our playlist.
I could be wrong. Readers, check out our Tell Me More Hospitality Data podcast playlist on Spotify, and you might just fact check us. So, I mean, hey, if it works, it works.
This time it actually is a better one. I mean, if I used it before, it wasn't that much of a roller coaster. Now it really is a roller coaster. It's like,
yeah, up, down.
Then we'll say, hey, listeners, why don't you send us your thoughts on the metaphor? We've never done this before, but I want to put that out there. Probably the best place to find us is on LinkedIn. You can find myself, Isaac, and or Jan, and give us your thought on what the industry feels like to you right at this moment. Is it a song? Is it a candy bar? Is it a season? Is it a state of mind, an emotion? That'll be fun. Find us and we will read out some of the best ones on our next episode. So, guys, as always, thank you both for your insight, and thank you to our listeners. We've had a great year and change of doing this podcast for you. So We love that you're with us. Find the latest global hotel industry news on hotelnewsnow.com. Find this podcast wherever you like to listen and give these guys both follows on LinkedIn. You know you can find them there. See you next episode. See you later, guys.
See ya and register for HTC.
March 1st.
Hi, I'm Davon Reed.
I'm Omari Head.
And I'm Chris Henry.
We're the hosts of the Next Gen and Lodging podcast on the Hotel News Now podcast network. It's a monthly show in which we interview a new generation of hoteliers to get their insights into a variety of disciplines and topics, from finance to food and beverage and hotel operations. Listen to us on Spotify, Google, Apple Podcasts, or wherever you get your podcasts.
This episode of Tell Me More, a hospitality data podcast, was recorded on February 19, 2025 by me, Stephanie Ricca. The episode was edited by Sean McCracken. Find all hotel industry news at hotelnewsnow.com. Subscribe to this and all Hotel News Now podcasts wherever you like to listen. Just search for Hotel News Now. Thank you.